Passive income with crypto, staking, yield farming, and liquidity mining explained. You might run upon words like staking, yield farming, and liquidity mining as you explore the DeFi metaverse. All of these pertain to a client investing their money in a blockchain, a DEX, decentralized exchange, a shared security plan, or some other prospective capital-intensive applications. Although many practical uses are similar, many features differ from one another. Staking. Of staking, yield farming, and liquidity pools, staking is the most extensive. It does, however, provide many non-crypto concepts that can help you determine your stake assets in a crypto network, unlike yield farming and liquidity pools. Staking, in its simplest form, is the act of keeping a specific amount of cryptocurrency in a wallet or exchange account and then using that balance to support the network. Depending on the particular coin you're staking, there are a few various ways you might go about doing this. Staking has grown in popularity over the past several years, in part because of the rewards it may bring. By staking your cryptocurrency, you can generate a passive revenue stream by receiving more coins in exchange for assisting the network. Staking can be a successful method to use your cryptocurrency holdings, albeit the amount of cryptocurrency you can make varies based on the particular cryptocurrency and the amount you stake. What exactly happens during staking? Depending on the coin you're staking, there are several different ways to stake. As an illustration, certain cryptocurrencies employ the proof of stake (POS) consensus process, which necessitates that validators stake a particular amount of the cryptocurrency to join the network and approve transactions. With the help of a delegated proof of stake (DPS) mechanism, users of other cryptocurrencies can elect delegates to validate transactions on their behalf. To better grasp it, let's look at a few examples. First, let's look at the POS consensus process used by the cryptocurrency Cardano, ADA. You need to stake a particular quantity of ADA to take part in the network as a validator. Your chances of being chosen to validate transactions and receive incentives increase as you stake more ADA. Validators are chosen at random, but those with higher stakes are more likely to be chosen. Let's now take a look at Tezos, XTZ, a DPS-based consensus system. Users in Tezos have the option to assign a delegate their staked coins, who will then validate transactions on their behalf. The community chooses the delegates, and those who have staked the most coins have a stronger chance of winning. Depending on how well a delegate performs, users that delegate their coins to them will receive rewards. Protocol assistance. Staking can be applied in several ways to accommodate different DeFi and encryption technologies. The Ethereum 2.0 paradigm is transitioning from proof of work (POW) to proof of stake (POS). To verify transactions on the Ethereum network and receive block rewards, validators will need to stake portions of 32 ETH rather than supplying the network with hashing power. Yield farming. The way of making money from crypto assets known as yield farming, or YF, is by far the most well-liked. By keeping their cryptocurrency in a liquidity pool, investors can get passive income. Similar to centralized finance or the SuFi equivalent of your bank account, these liquidity pools. You deposit money into the bank, and it uses those funds to credit loans to other people while giving you a defined share of the interest earned. The fundamental idea behind yield farming is to use your Bitcoin assets to earn income by lending them out or staking them in decentralized finance, DeFi, protocols. These protocols give a range of rewards, including governance tokens, to encourage users to secure their assets and fund the platform. Though more modern than staking, yield farming has many similarities to staking. While staking can refer to actions like locking up 32 ETH to become a validator node on the Ethereum 2.0 network, yield farming refers to providing liquidity to a DeFi protocol in exchange for yield. Farmers actively seek out investments with the highest return possible, swapping between pools to increase their profits. Investors new as yield farmers store cryptocurrency into a smart contract-based liquidity pool like ETH/USD, and this activity is referred to as yield farming. Other protocol users are subsequently given access to the locked assets. Users of the lending platform may borrow these tokens for margin trading. The foundation of DeFi protocols that offer financing and exchange services are yield farmers. They also support maintaining the liquidity of crypto assets on decentralized exchanges, DEX. Annual percentage yields, APYs, are the sort of payment that yield farmers get. AMM supports liquidity suppliers post two tokens, token A and token B, with token B commonly being ETH or a stablecoin like USDC or DAI, in exchange for a portion of the commissions paid by customers who utilize the pool to trade tokens. The returns received by each depositor are based on their share of the pool. They will earn 1% of the pool's total fees if their deposit is equivalent to 1% of the depth of the pool. What is the exact process of yield farming? An investor would first need to purchase a digital asset that is compatible with DeFi protocols, such as Ethereum or Binance Smart Chain, to begin to yield farming. They would then need to deposit the asset into a DeFi protocol, such as a liquidity pool, after they have obtained it. On DeFi networks, liquidity pools are collections of cryptocurrency assets that are secured by smart contracts and used to speed up transactions. A user receives liquidity pool tokens in exchange for putting money into a liquidity pool. These tokens stand in for the user's portion of the pool and can be redeemed for their portion of the pool's assets. Yield farmers can start earning more cryptocurrencies by contributing liquidity to the pool after depositing their assets into it. To accomplish this, they engage in a variety of DeFi activities, such as lending, borrowing, or trading, utilizing their liquidity pool tokens. Mining for liquidity. One of the most important factors in the success of DeFi is liquidity mining, which also serves as a powerful bootstrapping mechanism. Liquidity mining is a subset of YF, just as YF is a subset of staking. The main distinction is that in addition to fee income, liquidity providers are paid with the platform's coin. As liquidity is provided to DEXs via liquidity mining, traders can trade their assets without the aid of a centralized middleman, which has become a crucial component of the DeFi, decentralized finance, ecosystem. This decentralization lowers the transaction costs related to trading on centralized exchanges while simultaneously enhancing the platform's security. What exactly is the process of liquidity mining? Let's look at an example to better understand how liquidity mining functions. Let's say there is a DeFi protocol that enables consumers to exchange token A for token B. The protocol needs liquidity in the form of both tokens to support trading. By adding equal amounts of token A and token B to the liquidity pool, LPs can supply liquidity. Let's imagine a customer wishes to exchange 100 token A for 100 token B. The liquidity in the pool supplied by the LPs will be used by the protocol to carry out the trade. The protocol will automatically alter the prices to bring in more LPs to supply liquidity if there is not enough liquidity for the trade. DeFi systems use liquidity mining to reward users for supplying liquidity and enabling trade. The risk of temporary loss, which happens when the price of the tokens in the pool fluctuates about one another, is assumed by LPs by providing liquidity. However, the benefits gained by liquidity mining may be sufficient to make up for the temporary loss and even turn a profit. Supporting structures. When Compound started compensating users with Comp, its governance token, it became the first to use liquidity mining. The momentary loss risk that liquidity providers assume may be partially or entirely covered by this extra source of income. Liquidity mining advantages increased returns on investment. Liquidity mining gives traders the chance to increase their return on investment, which is one of its main advantages. The trading fees produced on the exchange, which can be much larger than those from conventional savings accounts or even some investment vehicles, are how liquidity providers are paid. This implies that traders can increase their returns on investment while simultaneously generating passive income. Portfolio diversification. Another advantage of liquidity mining is the portfolio diversification of a trader. Trading can be done on a variety of decentralized exchanges using a variety of tokens, allowing traders to diversify their investments and lower risks. Trading participants can invest in a variety of cryptocurrencies and profit from each investment by taking part in liquidity mining, which lowers their overall risk exposure. Possibility of earning passive income. Additionally, liquidity mining gives traders the chance to generate passive revenue without really trading. A trader can receive compensation depending on the number of trades executed on an exchange once they have lent liquidity to it, without actively monitoring the market or placing trades. This makes it possible for traders to make money even when the market is struggling or when they are unable to engage in active trading. So this is the end of our today's video. Do you like it? Share your precious thoughts with us in comments section below and subscribe to our YouTube channel.